America owes $38 trillion. The interest payments alone on this staggering debt burden now cost the federal government nearly $1 trillion annually, which means the United States spends more money just servicing its debt than it spends on national defense, more than it allocates to Medicare, and more than most entire national economies produce in a full year. This is no longer a conventional debt problem that can be solved through traditional fiscal policy. This has become a mathematical impossibility, disguised as manageable government finance, a fiscal black hole that grows larger with each passing month, regardless of what politicians promised. But here's what virtually nobody in mainstream media or government is telling you. The federal government isn't actually planning to repay this debt through higher taxes, spending cuts, or economic growth. Instead, they're planning something far more sophisticated and invisible. They're going to make approximately $25 trillion of real debt burden simply vanish over the next 2 decades through systematic currency devaluation. This isn't speculation or conspiracy theory. This is documented historical practice that has been used successfully by governments throughout modern history when they accumulate debts they cannot repay through conventional means. It's happening right now, using the exact same playbook that has been deployed multiple times before. Here at Economic Rewind, we specialize in breaking down the complex mechanisms of government finance to help you understand how these systems actually function, rather than how politicians claim they function. As of December 2025, America's gross national debt stands at $38.4 trillion. That number increased by $2.2 trillion in just the last 12 months. Over the past 5 years alone, total federal debt has grown by $11 trillion, an increase that dwarfs the economic output of most developed nations. The Congressional Budget Office projects that net interest payments will hit 13.85% of government spending in fiscal year 2026 and 14.52% by 2028. The Treasury paid out $92 billion per month in net interest during the final quarter of 2025, 13% higher than the previous year. Interest payments have become the federal government's second largest expenditure, surpassing Medicare and nearly matching defense spending. Since 2019, net interest expenses have nearly tripled, while other major spending categories grew at much more modest rates. This creates a vicious cycle that feeds on itself. More revenue goes to interest payments instead of productive spending, forcing additional borrowing to fund basic government operations. Additional borrowing means more interest owed, and the cycle compounds relentlessly. Can America tax its way out? The numbers say no. To balance the budget through taxation alone would require either doubling income taxes across all brackets or implementing austerity measures so severe they'd trigger immediate recession. Politicians from both parties understand this, which is why neither side seriously proposes it. What about cutting spending? Equally impossible. 2/3 of the federal budget consists of mandatory spending: Social Security, Medicare, Medicaid, and debt interest. These aren't discretionary items that can be trimmed. You could eliminate the entire discretionary budget and still wouldn't balance the books. Economic growth? The debt to GDP ratio currently sits at 120%. Historical evidence shows that debt burdens at this level actually constrain growth rather than enable it. Capital that could fund productive investment gets absorbed by government borrowing. The math doesn't work through conventional means. That brings us to the solution governments always choose in this situation. They systematically devalue their currency to reduce the real burden of debt obligations. Government debt is denominated in nominal dollars. If you hold a bond promising $100,000 in 10 years, you get exactly that amount, regardless of purchasing power. If those dollars have only half the purchasing power when received, the government technically fulfilled its obligation while effectively cutting the real debt burden in half. This wealth transfer happens through sustained inflation that exceeds government bond interest rates. If inflation runs at 6% annually, while bonds pay 4%, you're losing 2% per year in real terms, an invisible tax through currency devaluation. Economic models predict sustained inflation of just 6% could reduce the debt to GDP ratio by 20 percentage points within 4 years. That rate barely exceeds what America experienced following World War II. Not hyperinflation, but moderate currency devaluation, achieving the same debt reduction as explicit default without legal consequences. You're probably wondering how America accumulated such an impossibly large debt burden. The answer reveals systematic errors in thinking that led to this crisis. After the 2008 financial crisis, the Federal Reserve dropped interest rates to zero and purchased trillions in government bonds through quantitative easing. For the first time in modern history, the federal government could borrow enormous sums at virtually no cost. Politicians quickly discovered they could fund any spending program or tax cut without difficult choices. Defense increases, entitlement expansion, tax cuts? Why not, when borrowing was essentially free? This created a dangerous illusion of fiscal sustainability that lasted over a decade. Then, COVID-19 arrived, and the government deployed another $6 trillion in stimulus spending virtually overnight. Much was probably necessary to prevent economic collapse, but it was implemented without any realistic repayment plan. Now, interest rates have normalized, and the cheap debt accumulated during the emergency period is maturing and needs refinancing at rates triple or quadruple the original cost. A bond issued at 3% in 2020 comes due in 2025 and must be refinanced at 7 or 8%. This refinancing crisis is only beginning because most debt accumulated during the low interest period has 10 to 30-year terms. As these bonds mature, the Treasury will be forced to refinance trillions at much higher rates. So we've established the debt problem is mathematically unsolvable through traditional means. That brings us to the solution governments always choose: systematic currency devaluation through what economists call financial repression. The mechanism is straightforward from the government's perspective. Federal debt obligations are fixed in nominal dollars, but real value can be reduced through inflation without technically defaulting. When general price levels rise faster than bond returns, bondholders lose purchasing power, while government reduces real debt burden. This isn't theoretical. It's been executed successfully before, most notably following World War II, when America faced remarkably similar debt levels. In 1945, the United States faced massive government debt at 106% of GDP, very similar to today's burden. Instead of defaulting or implementing catastrophic austerity, American policymakers chose financial repression. The Federal Reserve kept interest rates artificially low while generating modest but sustained inflation that exceeded returns on government bonds. Anyone purchasing Treasury securities was guaranteed to lose purchasing power over time, but losses were gradual enough that most investors didn't realize what was happening. The strategy worked exactly as designed. Between 1945 and 1975, the debt-to-GDP ratio fell from 106% to just 35%, a reduction of over 2/3 without explicit debt forgiveness. Bondholders lost approximately 30 to 40% of real wealth over 3 decades, while the government's balance sheet normalized. What makes this approach politically attractive is that average people don't understand they're being taxed through inflation. When prices rise, people blame corporations or supply chains rather than connecting it to deliberate debt reduction policy. The current situation follows this exact playbook. The Federal Reserve has expanded its balance sheet to unprecedented levels, purchasing trillions in government bonds to keep interest rates artificially low. Treasury securities currently yield returns below inflation rates, guaranteeing purchasing power losses for bondholders. The Federal Reserve's dual mandate creates impossible conflicts. Genuinely fighting inflation would require raising rates high enough to slow employment, but higher rates would make debt service costs completely unmanageable. This creates powerful incentives to allow inflation above stated targets while keeping rates below market levels. Foreign creditors complicate the equation. Roughly 30% of US debt is held by foreign investors, with Japan holding over $1 trillion and China nearly another $1 trillion. These aren't passive investors who will accept negative returns indefinitely. The dollar's reserve currency status provides crucial flexibility that most countries don't possess. Global trade still runs primarily on dollars, creating structural demand for US debt, regardless of returns. But this advantage is eroding as other countries develop alternatives and reduce dollar dependence. The wealth transfer isn't future policy. It's operating right now while economists debate and politicians make promises everyone knows won't be fulfilled. You're living through the largest peacetime wealth transfer in American history. Every time inflation exceeds your savings account interest rate, you're paying the financial repression tax, systematic transfer of purchasing power to the government's balance sheet. Every time bond funds lose real value while showing nominal gains, you're financing government debt reduction. The Federal Reserve has maintained near zero rates for most of the period since 2008, keeping them below levels necessary for positive real returns. This generates negative real interest rates, where inflation exceeds available returns on safe investments. If inflation runs at 5% and savings pay 2%, you lose 3% purchasing power annually. Multiply that across millions of savers and trillions in wealth, and the transfer becomes enormous. The Fed has expanded its balance sheet from under $1 trillion before 2008 to nearly $9 trillion today. Direct purchases of government debt that essentially create money to finance spending while increasing money supply and inflationary pressure. Treasury auctions regularly see yields below current inflation, meaning guaranteed purchasing power losses. This would be impossible in free markets, but it's sustainable when the Fed acts as buyer of last resort. The process requires careful management because inflation expectations can become embedded if it moves too quickly. Workers demand higher wages, businesses raise prices in anticipation, and the economy adjusts to expect continued devaluation. Bond investors understand the incentive structure perfectly. They see the debt trajectory and know conventional repayment is impossible. This is why long-term yields have been rising relative to short-term rates. Markets are pricing in expectations of sustained, elevated inflation. Have you ever wondered why your savings seem to buy less every year, even when the economy appears to be growing? You're funding America's debt crisis solution through gradual erosion of your purchasing power. The government probably has 10 to 15 years where this strategy can work effectively. After that, demographics worsen as more baby boomers retire, foreign dollar holdings may decline further, and debt may compound beyond levels where inflation alone can manage it. What happens if this wealth transfer strategy fails? If inflation can't be sustained at levels high enough to erode debt without triggering expectation spirals or capital flight, you're left with limited options every over-indebted government eventually faces. Explicit default. The government announces it cannot honor debt obligations and restructures bonds. The US has never defaulted on its own currency debt, and almost certainly won't, because currency debasement remains politically easier and economically achievable. Extreme inflation, not modest 6 to 8% annually, but 20, 30, or higher rates that destroy currency value over years. The debt gets erased, but so does everyone's savings, wages, and economic stability. This happened in numerous countries when governments lost inflation control. Genuine austerity, massive spending cuts and tax increases regardless of political consequences. This happened in Greece during the European debt crisis, but the US won't face external pressure because it controls its own currency. None are politically desirable, which is why financial repression remains the chosen path. It transfers wealth slowly enough that most people don't notice until years later, avoids political catastrophe while maintaining appearance of normal policy. Understanding this doesn't give you many options for avoiding effects. You can't opt out of holding dollars if you live in America, and you can't completely avoid inflation's impact. But you can position assets to minimize wealth transfer by holding investments that appreciate with inflation rather than get eroded. Real estate that maintains inflation-adjusted value, equities in companies that can raise prices with inflation, commodities representing real economic value rather than monetary claims. The key is avoiding fixed-rate bonds and cash deposits that get systematically eroded by financial repression. These are exactly the investments government policy is designed to make unprofitable. The federal government isn't paying its debt conventionally. It's making debt disappear through the oldest trick in the sovereign borrower's playbook: inflation, financial repression, and negative real rates that silently transfer wealth from creditors to debtors. This strategy worked after World War II to eliminate seemingly unpayable debt, and there's no reason it won't work again if policymakers maintain necessary conditions. Success depends on variables largely outside direct control: demographic trends affecting spending, foreign creditor behavior influencing treasury demand, market expectations determining acceptable inflation levels, and debt accumulation speed versus inflation erosion rate. The next decade determines whether America manages this transition successfully or whether debt burden becomes genuinely unsustainable. Either way, wealth transfer is happening now, while politicians debate theories they have no intention of implementing. History suggests the strategy will succeed. Debt to GDP ratios can be cut in half over 2 decades through sustained negative real rates. Bondholders typically lose 30 to 40% of purchasing power. Government balance sheets normalize, and crises resolve without explicit default. Historical precedent suggests strongly that the strategy will ultimately succeed in reducing debt burdens to more manageable levels over the next 2 decades. Debt to GDP ratios can be systematically cut in half through sustained negative real interest rates implemented over extended periods. Bondholders typically lose 30 to 40% of their real purchasing power during such episodes. Government balance sheets get normalized to sustainable levels, and fiscal crises get resolved without the political upheaval of explicit default or economically devastating austerity programs. But success requires maintaining conditions that may no longer exist in the same form they did after World War II. A compliant population that accepts gradual currency debasement without organized political revolt. Foreign creditors who continue buying treasury securities despite guaranteed negative returns. And financial markets that don't completely anticipate and front-run the obvious strategy before it can be fully implemented. The demographics working against this strategy are particularly concerning. As baby boomers retire en masse over the next decade, Social Security and Medicare obligations will explode exponentially, creating even larger deficits that require financing. The ratio of workers to retirees continues declining, meaning fewer people generating tax revenue to support more people requiring government benefits. This demographic tsunami will coincide with the peak years of debt refinancing, when trillions of dollars in cheap pandemic-era debt must be rolled over at much higher interest rates. The convergence of these trends could overwhelm even the most sophisticated financial repression strategy. Additionally, the global monetary system is evolving in ways that could undermine dollar dominance. Central bank digital currencies are being developed by major economies, potentially offering alternatives to dollar-based international transactions. The BRICS nations continue expanding trade relationships that bypass the dollar entirely, gradually eroding the structural demand that makes financial repression feasible. If foreign creditors lose confidence in the strategy and begin selling treasury holdings en masse, it could trigger the very crisis that financial repression is designed to avoid. The Federal Reserve would face impossible choices: allow interest rates to spike and trigger fiscal crisis, or print money so aggressively that it destroys confidence in the currency entirely. The technological revolution also creates new challenges for managing inflation expectations. Social media and financial information platforms make it much easier for the public to understand what's happening to their purchasing power in real time. Unlike previous generations, who might not notice gradual wealth erosion for years, today's savers have immediate access to inflation data, real interest rate calculations, and educational content explaining financial repression. This increased financial literacy could make it much more difficult to maintain the political consensus necessary for sustained currency debasement. If enough people understand they're being systematically impoverished to solve the government's fiscal problems, political pressure for change could become overwhelming. Yet despite these challenges, the mathematical reality remains unchanged. With debt service costs already consuming nearly $1 trillion annually and growing exponentially, there are simply no other viable alternatives that are politically achievable in the current system. The scale of tax increases required to genuinely balance the budget would trigger immediate economic recession and social unrest. The spending cuts necessary would require eliminating Social Security, Medicare, and defense spending, political suicide for any party that proposed it. Economic growth sufficient to outpace debt accumulation appears mathematically impossible, given current demographic and productivity trends. This leaves currency debasement as the only remaining option, regardless of its risks or long-term consequences. The question isn't whether it will be attempted, but whether it can be executed successfully without triggering catastrophic side effects that could be worse than the debt crisis itself. For individuals trying to protect their wealth during this transition, the strategic implications are clear. Traditional safe haven investments, like government bonds and bank deposits, are specifically designed to lose value under financial repression. Cash savings will be systematically eroded through negative real interest rates maintained for extended periods. Real assets that maintain value during inflationary periods offer better protection. Real estate in desirable locations tends to appreciate with inflation over long time periods. Equities in companies with pricing power can maintain real value by raising prices along with general inflation. Commodities and precious metals have historically served as inflation hedges, though their performance can be volatile. The key insight is understanding that this isn't a temporary policy that will be reversed once the debt crisis passes. Financial repression becomes a permanent feature of the monetary system once debt reaches levels where conventional repayment becomes impossible. The process continues until debt burdens are reduced to sustainable levels, which could take decades to achieve. International diversification also becomes crucial for wealth preservation. While you can't completely escape dollar exposure if you live in America, holding some assets denominated in other currencies or located in other countries can provide partial protection against systematic dollar debasement. The irony is that the very success of financial repression depends on most people not understanding what's happening until it's too late to adjust their financial strategies effectively. Once everyone recognizes the wealth transfer, inflation expectations become embedded, and the strategy becomes much more difficult to control. This creates a race between policy implementation and public awareness. The government needs to erode enough debt before people figure out what's happening and demand changes that would make the strategy politically unsustainable. You're watching the largest peacetime wealth transfer in American history unfold in real time. From savers to borrowers, from private creditors to the federal government, from anyone holding dollars to anyone holding debt. Approximately $25 trillion of real economic obligations being systematically converted into devalued currency over the next 2 decades through monetary policy mechanisms that operate below the level of public awareness. The underlying mathematics are indisputable. The historical precedent is clear and well documented, and the policy execution is already fully operational through Federal Reserve balance sheet operations and Treasury financing mechanisms. Whether this process proceeds as controlled, gradual erosion or evolves into more chaotic economic collapse, the fundamental direction has been determined by mathematical realities and political constraints that are now beyond the control of any individual policymakers or election outcomes. America isn't paying its debt through higher taxes, dramatic spending cuts, or miraculous economic growth that would generate sufficient revenue to service these obligations honestly. Instead, the government is making that debt disappear through the purchasing power that you're losing every single day, transferred invisibly from your savings account to the Treasury's balance sheet, through sophisticated monetary policy and financial repression mechanisms that operate through market forces rather than explicit legislative action. The strategy worked after World War II because the conditions were ideal for financial repression. A growing population with expanding economic opportunities, a rapidly expanding economy with strong productivity growth, limited financial alternatives for investors seeking safe returns, and minimal international competition for reserve currency status. Today's environment is significantly more challenging on every dimension, but the underlying mathematical imperatives remain fundamentally unchanged. Success or failure will depend on variables largely outside direct policy control. How quickly demographics deteriorate, how aggressively foreign creditors reduce dollar exposure, how effectively the public can be kept unaware of the wealth transfer process, and whether financial markets continue cooperating with artificial interest rate suppression. The next decade represents a critical period where these forces will collide and determine whether America successfully manages this transition or faces a more chaotic resolution to its debt crisis. Either way, the wealth transfer is already underway and accelerating, reshaping the American economy in ways that most people won't recognize until the process is complete and irreversible. Understanding this dynamic doesn't provide easy solutions, but it does offer the possibility of making informed decisions about how to position your financial life for an environment where currency debasement becomes a permanent feature of monetary policy, rather than a temporary emergency measure. Here's my personal take on what this means for ordinary Americans. We're witnessing the greatest transfer of wealth from the middle class to the government in our nation's history. And it's happening through mechanisms that most people will never understand until it's too late to protect themselves. The tragic irony is that the very people who trusted the government most, retirees who bought treasury bonds thinking they were the safest investment, savers who followed conventional wisdom about emergency funds in bank accounts, pensioners whose retirement funds are loaded with government securities, these are exactly the people who will bear the heaviest burden of this wealth transfer. Meanwhile, the wealthy who understand these dynamics have already positioned their assets in real estate, stocks, and other inflation-hedged investments. They'll not only survive this transition, but actually benefit from it, as their debt becomes cheaper to service while their assets appreciate in nominal terms. This isn't just an economic policy. It's a moral choice about who bears the cost of decades of fiscal irresponsibility. The government chose to spend money it didn't have, made promises it couldn't keep, and now, rather than face the political consequences of honest solutions, it's choosing to quietly steal purchasing power from the most vulnerable members of society. The elderly widow living on fixed income bonds, the young couple trying to save for a house down payment, the middle-class family watching their purchasing power slowly erode. These people didn't create this debt crisis, but they're the ones paying for it through systematically reduced living standards. What makes this particularly insidious is the gaslighting that accompanies the process. When people notice their groceries cost more, their rent is higher, their savings buy less, they're told it's corporate greed or supply chain issues. Anything except the truth that their government is deliberately making them poorer to solve its own financial problems. I believe every American deserves to understand exactly how this process works, because only through widespread awareness can we hope to force more honest solutions, or at least protect ourselves from the worst effects of this systematic wealth confiscation. The fact that this strategy requires public ignorance to succeed tells you everything you need to know about its morality. If financial repression were genuinely in the public interest, it would be debated openly, rather than hidden behind technical monetary policy jargon that obscures its true purpose. If you found this comprehensive analysis of America's debt elimination strategy enlightening and want to understand how these powerful financial forces actually shape your economic future, make sure to subscribe to Economic Rewind and hit that notification bell for more deep dives into how monetary policy and government finance actually work versus how they're presented to the public by politicians and media outlets. What other aspects of government finance, currency devaluation, or wealth transfer mechanisms would you like us to examine in detail? Let me know in the comments below.